Hello class, this short video is going to cover some new accounts from Chapter 10 that are included in your Statement of Stockholders' Equity. If you remember, there are 4 financial statements. First, we create the income statement. It's for a month, quarter, or year, and then we close out those temporary accounts, revenues, expenses, and dividends into our savings account, the retained earnings account. And that shows up on the second financial statement, which is all about stockholders' equity and the internal organic worth of the company. You'll see that on your Chapter 10 information regarding the earned capital or the invested capital coming from your shareholders, your common stock and your preferred stock. It's another type of stock that we're going to cover. It costs a premium because it has additional features, so it's going to cost more, but you have additional benefits with it. It has preference to dividends. If the company decides to pay dividends, they'll pay preferred, hence those people are preferred shareholders over the common stock shareholders. Common stock shareholders have voting rights, but they don't have the additional features of the preferred stock. Also, preferred stock has preference when it comes to liquidation. If the company dissolves or they go bankrupt or decide to no longer be in business, they'll pay their creditors first and then the preferred shareholders and then the common stock shareholders. So 2 other new accounts besides the preferred stock is going to be your treasury stock. When the company buys back stock, it's going to be taking back some of the common stock, and it's going to be renamed as treasury stock. Treasury stock is a contra equity. Contra equity accounts, this contra equity account has a normal debit balance. All of the other equity accounts, common, retained, stock, additional paid in capital, have a normal credit balance. But this is what we like to call a bad asset, or it's not an asset, but a bad account in a sense that it takes away from external ownership. It's a contra. It's going to have the opposite effect of your normal equity accounts. Okay, so then once we just discuss a few items regarding the initial authorization of shares, those are the ones available when you first set up your company. When you sell them, we call them issued and sold, or synonyms. And then when you buy back your shares, we call that repurchasing those. Those are classified as treasury stock, as I said earlier. They're no longer outstanding. So if you're going to pay a dividend, you first need to calculate the number of shares outstanding. So outstanding is your beginning shares outstanding plus any issued or reissued minus the number of shares you've bought back, you've repurchased. Then you'll know your total outstanding. You can pay a dividend on that. When you're recording shares now, in this chapter, if you see a par value, that is the legal value, not the market value, not the stock price. That's what it's selling. The legal value is not what it's selling for. The legal value is stated on articles of incorporation. That is what will go into the account accounting-wise, the par value. If there's a $1 par and the stock was sold for $5, the $5 is what the market is dictating it to be worth, what it's selling for on the market. So this will equal, if that's $1, the par value is $1. That's actually what would go in here. If you sold it for $5 and you received $5 cash, where's the other 4 go? That goes here into the additional paid in capital account. So you have a debit to cash for 5, a credit to common for 1, and a credit to additional paid in capital for 4. So that is primarily the new verbiage. I'll discuss a couple of journal entries regarding treasury stock next, and then we'll wrap up the chapter. Okay, so now I'd like to cover a few journal entries. In this chapter, we talk about the par value, as stated a few minutes ago. That's the legal made-up value that goes into that account. So if a company sells 500 shares for $10, that's what it's selling on the market per share, with a $1 par value. What you would put in the common stock account is 1, the par value, multiplied by the number of shares. So we sold 500 shares, but we sold those shares for $10 a piece. So that's how much cash we've received. So $5,000 in cash, but we're only going to report $500 in the common stock account. The rest of it, in addition to par, is going to go in this additional paid in capital. So the 9 times 500 shares is what's showing up in that additional paid-in capital, which is another normal credit balanced equity account. If you buy back some of those shares, if we buy back 100 of those 500 shares, we're going to buy back 100 for $12 a piece. We're now going to rename them as Treasury Stock. So 100 shares bought back, and we paid $12 each. What's happening to the accounting equation is you're reducing your assets because you're paying out cash, and you're reducing the total external ownership. You've bought back some of those outstanding shares. So the next step is to fully understand if we do a reissue of those shares. So if we do a reissue of those shares and we sell them, let's say for $9 a share, we're going to post 9 times 100 here in the cash. So if we sold 100 shares at $9 a piece, that's how much cash we've received. But what has to come out of the Treasury Stock account is not the $9 per share. It's going to have to be the original value, the $12 per share. So you're going to credit your Treasury Stock for $1,200, and you're going to debit your additional paid-in capital for the difference, the loss there, which was $3 a share on 100 shares. If you had sold it for more than what you paid for it, this would stay the same. You would increase your cash, and your total to additional paid-in capital would go up. So again, this is an example of when you have sold your Treasury Stock for less than what you paid for it. When that happens, your initial value is what comes in and out of the Treasury Stock. See how we paid $12 for it? So when we resell it or reissue it is the way it's going to be worded. We're only going to get $9 per share, and that's how much cash we're going to receive. But the $1,200, the original value per share, has to come out of that account. Again, if we sold it for more, it would kind of be like a gain, and all your revenues and your gains go in as credits. So we would use that same account, but we would credit it. You really need to also think about when you're paying dividends, there's a short little formula that will help you in calculating your dividends, and it will say beginning plus any issued or reissued shares, only looking at the number of the shares, not the value of those shares, but the quantity. Take the beginning outstanding shares plus reissued and issued minus purchased back, repurchased, bought back shares will equal your current outstanding shares. That number of shares gets multiplied by the dividend paid per share. So that's the majority of Chapter 10. Please let me know if you have any questions.